South Africa is showing fresh signs of economic stabilization buoyed by easing inflation, improved credit ratings and progress on structural reforms. Data shows consumer inflation rose slightly to 3.6% in December, while averaging a low 3.2% for 2025, the weakest inflation performance in more than 2 decades. The country has also adjusted its inflation target to 3% within a 1% tolerance band. Beyond prices, investor sentiment has improved following a credit rating upgrade by S&P, South Africa's removal from the FATF grey list and the European Union's high-risk register, alongside nearly 300 consecutive days without load shedding in the energy sector. Now, Lesetja Kganyago, governor of the South Africa's Reserve Bank, spoke to Arise business correspondent and the anchor of the Global Business Report, Roger Dere, at the ongoing World Economic Forum in Davos.
Let's talk about South Africa. Encouraging economic news for the South African delegation coming into Davos. Standard & Poor's upgrading their sovereign credit rating in November of 2025, being taken off the Financial Action Task Force grey list, also being taken off the European Union's high-risk jurisdiction list, and also the head of Eskom saying that there have been 300 consecutive days of no load shedding. Let's talk monetary policy, which is what, of course, we're going to be discussing with our guest today. Inflation just coming in for December, slight uptick to 3.6%. This is headline from 3.5 in November. Inflation in South Africa, though, averaging about 3.2% for the year, lowest in about 2 decades. And also, we've had this Reserve Bank of South Africa reducing or adjusting its interest rate band from between 3% to 6% down to 3% with a 1% tolerance. So we're going to talk about that plus a whole lot more. I am incredibly excited to have Lesetja Kganyago, the governor of the Reserve Bank of South Africa, with us. You're welcome, sir. Thank you so much for being with us. Inflation, so those numbers coming in for December, 3.6 from 3.5. Analysts are still expecting rate cuts this year. Do you agree? What's your outlook with that regard?
Well, we have got a policy meeting coming next week, so you will know for sure on Thursday exactly what we would do. The inflation figure that come out is in line with the expectations of the Reserve Bank, and interestingly with that of the market. Inflation averaged 3.2% in 2025. But that is the past. Right. The past does not determine what future policy should look like. What is important is the outlook. And the outlook for inflation over the next 12 months is that we will continue to have inflation with a handle of 3%, and we expect the average for inflation this year to be around 3.5%. And we will continue to assess incoming data. In terms of the rates outlook at the November meeting, our quarterly projection model had forecast 2 rate cuts of 25 basis points over the next 12 to 18 months. But this is just a policy guide that changes from meeting to meeting, and depending on incoming data and the outlook, and it is by no means a definitive path of where monetary policy is going.
Duly noted, sir. Governor, can you talk to us about the decision to adjust the CPI target from between 3 to 6% down to 3% with a 1% tolerance band? Can you talk to us about that?
Well, South Africa introduced inflation target 25 years ago. It will be the 26th this year. And our inflation target band had been high, and it had been too wide and out of line with that of peers. We had been doing work for the past 24 to 36 months, and we came to the conclusion that the correct target to aim for South Africa is 3%. We believe that 3% will be consistent with the price stability mandate. Secondly, we believe that it will enhance South Africa's competitiveness. And thirdly, we believe that it will transform the South African economy into a low inflation economy. What we have seen so far in terms of data is that things are going according to our initial predictions when we decided to revise the target. Government bond yields are down 200 basis points across the yield curve. Inflation expectations are at their lowest since the surveys started in 2011. And we can actually see that it was actually a correct call to lower the inflation target.
All right. Now, you mentioned price stability going forward, that this target is more in line with that. I want to talk about exogenous shocks, and maybe I'm taking you to the fiscal side. You're a monetary policy executive, but you still have vast knowledge of fiscal matters. Donald Trump's speech, I just wanted to get your take on maybe the whole geopolitical concerns and if that might impact South Africa.
Of course, it will impact South Africa. As a matter of course, governors don't respond to what presidents say. We take what the presidents have said and say, how will it impact the way in which we analyze the economy. In January last year, we ran a scenario as the South African Reserve Bank, and that scenario said, what if the U.S. cancels AGOA and impose a 25% tariff on South African exports? We were out by 5 percentage points because yes, they removed AGOA, and they imposed tariffs of 30%. Over time, they exempted certain minerals that they are actually looking for, and later on they exempted agricultural products that they are looking for. And that for us as a central bank, we look at this and it generates a lot of uncertainty. From an inflation side, the tariffs are not affecting our inflation outlook that much anyway. Part of it is that tariffs impact on prices in the country that imposes tariffs, not the one that is exposed to the tariffs. So the impact of the tariffs are more on the economic activity side rather than on the inflation side.
Well, speaking of economic activity, let me get my final question for you, just to get your outlook. You know, bringing in power, and yes, electricity has been 300 consecutive days, no load shedding. What, I guess you mentioned 1.4%. Are you sticking to that, or can you talk about your overall outlook for the economy?
We will present an updated forecast next week. The one that I'm giving you is what we had in November last year. And I think that the things that are going for South Africa are threefold. The reform on the monetary policy side with the lowering of the target, that had impacted the cost of capital. The cost of capital had actually gone down. And in our own analysis, the lowering of the cost of capital should lead to a rise in investments, and that is a positive. On the fiscal side, South Africa now has had 3 consecutive years of primary surpluses. And that is what South Africa needed to stabilize and then reduce the debt level. And thirdly, you mentioned the issue of power, the reforms in the energy sector, the reforms in the logistics sector that allowed the private sector to come in. All of those are underpinning the new growth momentum that we are seeing in South Africa.